Hello, this is David again. Sorry, it's been a couple of weeks since I posted a video. It's been kind of busy lately and working on a home improvement project. But today we're going to go over we're going to try to understand a little bit more about the S&P 500, the Dow Jones, and NASDAQ. These are very important and very useful um, stock market indexes. And I'm just going to kind of go over the basics, discuss what's the difference between them, discuss which one is more popular, and so forth. All right, so let's get started. All right, so we have our introduction. The stock indexes track groups of companies. They show overall market performance, and we'll focus on the Dow Jones and S&P 500 and NASDAQ. Now, keep in mind, if you go, let's say, to the Wall Street Journal or to some other financial website, you're going to see more indexes than just these. So, for example, you might have the S&P 250 or you might have the S&P 1000. There's also other stock market indexes from around the world. So, for example, London has the FTSE, Tokyo has the Nikkei, and you have just different stock market indexes throughout the whole world. But these are the three big ones that we focus on here, particularly in the United States. And we're going to just kind of look over the performance from the past 10 years. All right, so we have the Dow Jones Industrial Average. That one is the oldest one. It tracks 30 major U.S. companies. Typically, they are the largest U.S. companies. It is price weighted index, so based on how much each company makes part of the make up the index, it is weighted. So, for example, if you have a much larger company, it's going to be weighted heavier than, say, one that's a little bit smaller. But these are the 30 U.S. major companies. This was established in 1896, and it usually represents traditional U.S. industries. So, for example, some years ago, it was General Electric was in the Dow Jones Industrial Average, but since then it's been removed because General Electric has had a lot of problems in probably the past 10, 15 years. They do change the U.S. companies out in the Dow Jones. So, for example, if some companies grow and improve over time, they might put them in and take other ones out, and so forth. All right, the S&P 500, it tracks 500 large U.S. companies. They're market cap weighted, so this is based on their market capitalization. So if you have a company that's has a huge market capitalization, it's going to be weighted heavier than one that's has lower market cap. This was created in 1957, and it is today considered the best gauge of the U.S. stock market. So we're taking 500 of the largest companies and we are tracking them in an index. And so it is extremely popular with investors, as opposed to the Dow Jones, which is only 30 companies. This has 500 companies. And then finally, we have the NASDAQ composite. The NASDAQ tracks over 3,000 companies. This is for tech-heavy or market cap weighted. So a lot of your tech companies, such as Facebook, Microsoft, Apple, these are listed in the NASDAQ composite because they're tech companies. And this was established in 1971, this composite. All right, so here we have the Dow Jones Industrial Average, and this is just from the past 10 years, so going back to looks like July 2016. As you can tell, it's had some fluctuations. If you look on the year 2020, we had the great pandemic, and so we had a huge drop in the market there, and had some fluctuations going on in the past couple of years. We had kind of a big drop off in early 2025. That was with the Liberation Day tariffs, the trade wars. But it has gone back up since that point. But overall, the trend is upwards. So if you are an investor, um, if you purchased, I don't know, stocks back in 2016, 2017, and you've held on to them despite all the ups and downs of the market, they should be doing quite well by now, providing, of course, it's a good, stable company uh, as opposed to a company that's gone bankrupt. Let's go to the S&P 500. Again, we have the 10-year performance. Again, we have the big dip in 2020 from the pandemic, and then we have a second big sharp dip here in 2025, but it has been recovering. Again, it's going to be trending upwards. A lot of people will follow the S&P 500 closely, and it's quite popular for ETFs or mutual funds to be focused on the S&P 500, so they will invest accordingly those funds to follow or track the S&P 500. And then we have the NASDAQ. NASDAQ, same thing. It's going to be trending upwards. NASDAQ is important, of course, with the tech companies, but because it's concentrated on the tech industry, it tends to be highly volatile, much more volatile than, say, the S&P 500, because tech companies, um, when you're dealing with technology, you're constantly having to improve your products, do research, improve your technology, and so there's this. If you're not improving your technology, then you're starting to fall behind. So there's a lot more volatility with regards to profits and with regards to the NASDAQ composite, as opposed to, let's say, Walmart. Walmart is not a tech-heavy company; it's a retail store, and the profits of Walmart is going to be less than a tech company that's making microchips, like Nvidia, because Walmart does not need to invest so much money in uh, research and development. And no matter whether the economy is good or bad, people have to go to Walmart to go buy groceries, to go buy other basic goods. So the NASDAQ, because it's made of tech companies, tends to be highly volatile in that, its daily fluctuations. All right, now key differences. Again, the Dow Jones has only 30 stocks. It's price weighted. It's the oldest index. S&P 500 has 500 stocks. It's market cap weighted. It's a broad benchmark of the stock market, so it's the most popular as far as gauging how well the market is doing. NASDAQ, 3,000 stocks. It's tech heavy. It's market cap weighted, and it tends to be a lot more volatile in its swings compared to the other two, because it is a tech heavy index. And why do they matter? Well, they show the health of the U.S. economy. Like I said, it's a measurement. It's a point where you can say, okay, we're doing well, we're doing better than last year, or we're not doing as well. It's just kind of, it shows us how things are going in the overall U.S. economy. It's used as benchmarks for investments. So a lot of times, if you're an investor, you're wanting to hopefully do as well as the benchmark. So, for example, uh, if you have a portfolio of stocks, maybe you might be hoping to beat the S&P 500 return. you wanted to achieve a greater return. And so you can kind of benchmark yourself to see how your investments are doing compared to the overall market. And then, of course, it impacts investor sentiment in global markets. So you have investors, traders who are constantly watching the markets to see what's happening, what changes might be taking place, what's causing fluctuations in the indexes. And so that's if you see, for example, if you're an investor and you start seeing these indexes going down, uh, I'm not recommending this, but some people tend to panic sell. Or if you have a feeling that the market's going to be going back up, then you might start buying more stocks and so on. All right, conclusion and takeaways. Well, the Dow Jones is a traditional economic measure. S&P 500 is a reliable benchmark for U.S. markets. NASDAQ is tech-driven growth. And together, these indexes provide a complete market picture of the U.S. Uh, stock market. And again, of course, you have other market indexes that you could find on your own in Wall Street Journal or Yahoo Finance or some of the other websites. All right, thank you for your time, and I will try to start posting more videos pretty soon. Thank you.